You have a note on your phone. You made it 6 weeks ago. It's called The Idea, and it has 3 bullet points, a rough revenue estimate, and a fourth bullet point that just says, figure out marketing. You open it occasionally, usually late at night, usually after a bad day at work. Stare at it for a few minutes, feel something between excitement and low-grade dread, and then lock your phone and go to sleep. You haven't told many people about it, because if you tell people, they'll ask how it's going. And right now, the honest answer is, it's a note on your phone with 4 bullet points, one of which says, figure out marketing. This is where most business stories actually begin, not with a bold resignation or a viral launch, with a note, a spreadsheet, a late-night browser tab, a version of the idea that keeps refusing to go away no matter how many times you close it. Today, we're walking through what happens when you actually do something about it, level by level with the real numbers, not the ones that sell courses. This is the most financially stable you will be for the next several years, appreciated because it won't last. You have a salary. It hits your account on a predictable schedule, which is genuinely a remarkable feature that you will miss in ways you cannot currently imagine. You have health insurance that someone else partially pays for. You have paid sick days, which means you can have the flu without it also being a financial event. And somewhere around 2:30 on a Thursday afternoon, it's always a Thursday. Nobody has an existential crisis on a Monday. You're too tired. You open a new tab and start calculating. If I could just clear $4,000 a month on my own, I could leave. I could do this. Here's what that calculation is missing: self-employment tax, health insurance you now pay entirely, an unpredictable income that doesn't arrive in even bi-weekly deposits, quarterly estimated taxes that will ambush you the first time, equipment, software, liability insurance, accounting fees, and the months when revenue is $600 because the world just decided that. 6 in 10 Americans say they'd prefer to work for themselves. Only about 1 in 10 ever actually attempts it. The rest update the note on their phone. They watch YouTube videos about passive income at 11 p.m., and I'm not judging, I'm noting where you currently are. Here is the uncomfortable truth about level 0. The people who leave are not necessarily smarter or more talented. They're just the ones who stopped waiting until the plan was perfect. The plan never becomes perfect. At some point, you either move or you don't. The morning after you leave, you sit at your kitchen table at 8 a.m. with nowhere to be. No calendar notifications, no mandatory stand-up meeting that could have been an email, just quiet. By 10 a.m., you've reorganized your to-do list, made a second, better formatted to-do list from the first one, and watched a YouTube video about getting your first client, which you didn't finish because a related video about building recurring revenue seemed more immediately important. You haven't earned anything. Your former colleagues are in the weekly status meeting right now, and you would genuinely trade something to be complaining about that meeting. Here's the financial reality at launch. Research on small business startups consistently finds that the majority are funded out of personal savings, with most requiring under $25,000 to get off the ground. Financial advisors recommend 3 to 6 months of runway. Entrepreneurs who actually survive tend to have 12 to 18 months saved before they leave. If you quit with $18,000 in savings and your fixed monthly expenses are $3,200, you have roughly 5 months before genuine crisis. That's not a runway. That's a short hallway with a concrete wall at the end. The identity piece hits immediately, which nobody warns you about. Your job was more woven into your sense of self than you realized. Now it's gone. The freedom doesn't feel like freedom yet. It just feels like the absence of something familiar, and you're not entirely sure what to do with the silence. Here's where the math gets genuinely brutal. Research on early-stage entrepreneurs puts the median personal income for a solo operator in year 1 around $24,000, not revenue, income. That's $2,000 a month, less than rent in most cities where knowledge work actually exists. You are working harder than you have ever worked, routinely 55 to 65 hours a week, to earn significantly less than you made as an employee. Meanwhile, roughly a third of your week goes to tasks that don't directly generate revenue: invoicing, chasing invoices, administrative work, client communication that isn't billable, the accounting software learning curve that you didn't budget time for. So of those 60 hours, perhaps 40 are actually pointed at anything that could theoretically pay you. What year one actually feels like, it's having more browser tabs open than your laptop can handle because you're the marketing department, the operations department, the customer service department, and the actual service provider, all at once. It's seeing a bank balance that's technically not zero, but trending in a direction that requires monitoring. It's renaming the spreadsheet from the plan to updated plan to actual working plan V4, and none of the versions having the same numbers. About 20% of businesses don't survive year one. The primary cause isn't a bad idea, it's running out of cash, because expenses run faster than projections. Projections are made by someone who hasn't done the thing yet, and the two numbers almost never agree. Survive year one, not thrive, just survive, and the next phase looks genuinely different. Your first $10,000 month arrives, maybe month 8, maybe month 14. The feeling is hard to explain to someone who hasn't been here. It's not just financial relief, it's evidence, proof that the thing works, that you weren't completely wrong, that the people who smiled politely while privately assuming this was going to fail were, in fact, wrong. You have dinner somewhere nice and order without checking the right column of the menu. This is not a small thing. After a year of mental math on every transaction, ordering without checking the price is its own form of luxury. And then, very naturally, you upgrade a few things: a better workspace, a new piece of equipment, a subscription service that seemed justified because revenue is finally coming in. Here's the trap. Revenue moves like weather. It spikes and drops based on factors outside your control: seasonal demand, client decisions, a slow month that arrives with no warning. Your expenses, once added, function like a ratchet. They only move in one direction. 3 months after your best month, revenue comes in at $2,800. The upgraded expenses don't know that. The monthly cost structure doesn't adjust for a slow quarter. You've built fixed costs on top of a variable income, which is the specific version of financial risk that sinks businesses that were otherwise working. The rule that no one posts about because it doesn't make for inspiring content: stay lean until revenue is consistent, contracted, and recurring, not just high once. One good month is not a business. 12 months of reliable revenue is a business. Years 2 through 4, the average solo business generates around $55,000 to $60,000 in annual revenue. That sounds like $5,000 a month until you remember that's gross, before expenses, before self-employment tax, before the quarterly estimated payment you forgot about until a strongly worded letter arrived. And it doesn't land evenly. You'll have an $11,000 month, followed by a $1,400 month, followed by an email from your biggest client that begins with, "We've really valued our partnership with you," and you know from the first 8 words exactly where that sentence ends. This is the phase researchers and founders call the grind, the gap, the long middle. You're not failing in any visible way, but you're not clearly succeeding either. The novelty has completely worn off. The stories you told yourself about what entrepreneurship would feel like have been replaced by the actual experience of it, which is less glamorous and more logistical than the version you imagined. A landmark study found that nearly 74% of entrepreneurs deal with mental health challenges. Depression rates among founders are roughly 4 times the general population. Isolation is significant. Working alone with unpredictable income in a role that nobody around you fully understands is genuinely hard in ways that compound over time. Most businesses that fail don't get killed by the market. The founders stop, not because the business couldn't work, but because they ran out of a resource that doesn't appear on any financial statement. The ones who don't stop are approaching the inflection point that changes everything. You hear an invisible ceiling somewhere around hour 70 of a 70-hour week. You're writing the proposal, delivering the work, managing the client relationship, billing, following up on billing, handling social media, responding to the email about social media, and somewhere in that list you were supposed to be eating meals and sleeping. Something has to give. What gives is the assumption that this was ever supposed to be done by one person. The financial data on this is striking. Median income for a solo entrepreneur around $24,000 a year. Median income for an entrepreneur who has employees roughly $110,000. Same general category of activity, 4.5 times the income. The team isn't overhead. The team is the mechanism that makes the business scale. But here's what the hire your first employee content typically skips. A $42,000 salary doesn't cost $42,000. Add payroll taxes, workers' compensation, benefits, equipment, software licenses, and the real cost is $52,000 to $58,000 per year. You've taken on a significant fixed obligation before that person has generated a single dollar for you. And then the first payroll run happens. You transfer money from your business account to someone else's account. Your stomach drops in a way you weren't prepared for. That used to be yours. Now it leaves every 2 weeks whether or not the month was good. You've graduated from can I cover my bills to can I cover everyone's bills. It is more stressful and more motivating than anything before it. And it means you've built something that exists beyond your own daily output. That's new. And it's the beginning of what the real numbers look like. Your business does $500,000 in revenue. Your LinkedIn says founder. Someone at a gathering says that must be so freeing, and you smile and don't explain what happens to $500,000 after it runs through the actual math. Average net profit margins across small businesses run 7 to 10%. At 10%, your $500,000 becomes $50,000 in profit. Self-employment tax takes 15.3% on top of income tax because as a business owner, you pay both sides. Your personal take-home lands somewhere between $35,000 and $45,000. You've built a $500,000 business and are personally earning less than median household income. Even in the best case scenario, consulting, professional services, 20% margins, you're clearing $85,000 after tax, which sounds reasonable until you price out what a $100,000 employee salary actually costs in healthcare, retirement matching, and security. You need $130,000 to $150,000 in self-employed income to replicate it. And yet, here's the long game. Research tracking entrepreneurial income over careers finds that by their mid-50s, employer entrepreneurs earn significantly more than equivalent employees, with median net worth approaching $3 million. The payoff is real. The timeline is just much longer and harder than anyone describes when they're selling you on the idea. Here's the full truth about this journey. Around 65% of businesses don't make it to year 10. The founders who didn't make it aren't on podcasts talking about pivoting. They absorbed $150,000 to $250,000 in direct costs and foregone salary on something that didn't work, plus years of their life.